The maddening thing about the UK tax system is that you might be earning exactly the same amount as your next door neighbour, but they'll end up paying less tax, and as a result, end up being able to save more money, investing that money more tax efficiently, and probably ending up retiring earlier. Why? Because they know how the tax system works and how to use it to their advantage. When it comes to retirement planning, everyone spends so much time focusing on trying to get better investment returns, without realizing that that is largely outside of your control. What is in your control is paying less tax. As a financial advisor, I have seen people missing opportunities and making simple mistakes that end up costing them hundreds of thousands. These are people that are not earning huge amounts of money, and it's all due to a lack of education, a lack of awareness. So today, I'm going to show you some of the biggest mistakes I see people making so that you can avoid making them in the future. The first half of this video is going to focus on how you can be tax efficient before you retire. But the second part is about creating a tax efficient income once you've already retired. And as you're going to see, this is where the biggest mistakes get made. So let's get started. On my last video, one of you left a comment outlining your financial situation, and I want to read it out because I think there's a lot we can learn from it. I am 53 and have 500k in an ISA and 270k in pensions. The ISA is yielding 30k a year from dividends. I've been budgeting and tracking my cash flow for several years, and my outflow is 35k. My income is around £90,000 with bonuses, and I save and invest most of them. I have 70k left on my mortgage that is locked on 1.6% until 2027. Now, there is no name here, so I'm going to assume that this is a woman based on the picture, and let's call her Lois. In another comment, Lois said that back in 2010, she set herself a goal of having a retirement pot by 2025. Back then, she only had £40,000 in her ISA, but over the last 13 years, she has managed to max out her ISA allowance each year and grow it to £500,000. Now, before we start looking at the things that Lois could have done better, let's first recognize what an incredible achievement that is. Saving £20,000 per year on an income of 90 grand while still paying a mortgage and completely turning around her retirement plans in just 13 years. That is phenomenal work. Now, Lois, if you're watching, I don't know the full extent of your personal situation, so there may be reasons why you chose not to do these things, but I think there is a few opportunities that you might have missed that could have left you in an even better position. Now, I only want to touch on this one briefly because this video is about tax, but Lois has said that she's getting £30,000 per year in dividends from her ISA, which equates to a 6% yield. So I'm assuming that her portfolio is entirely invested in high dividend paying stocks. People often like the idea of dividend investing, especially when they get closer to retirement, because they like the idea of having a passive income coming in. But investing for dividends is typically an inefficient way to invest. Now, I don't know how long she's been following this strategy, but there may be some evidence of this inefficiency here. If she started with £40,000 in her ISA in 2010 and contributed £20,000 each year since, she would have contributed about £320,000 or £340,000 in total, meaning she's seen investment growth of 160 grand. But is that any good? As a benchmark, if Lois had instead invested in an index fund that tracks the global stock market, her ISA would be worth over £850,000 today. To be clear, this may not be a perfect benchmark to use because perhaps Lois has only just started following this strategy and was previously invested in something lower risk. She also may not have actually maxed out her ISA in every single year, but this does demonstrate why, especially when you're actively managing your portfolio like this, it's so important to benchmark your investment returns so that you can keep tabs on how well you're doing. Okay, so that's enough about dividends. Let's get back to tax. Lois has been maxing out her ISA each year, saving a huge amount, which is a great achievement. She's ended up with 500k in ISAs, but she only has 270k in pensions, which may be a missed opportunity. As a higher rate taxpayer, if she is able to sacrifice some of her salary into her workplace pension, she saves on both national insurance and income tax. So instead of saving £20,000 per year into her ISA, she could have been saving £34,500 per year into her pension. And if she had been prioritizing paying into her pension instead of an ISA over the last 13 years and got 40% tax relief on all those contributions, she would have an extra £862,000 in her pension today, or a total of 1.13 million in her pension. And that's assuming she followed the same investment strategy that she was before. That's certainly a hell of a lot more money, but we're not really comparing apples with apples here. Firstly, Lois can't access the money in her pension until she's 55, whereas with an ISA, she can access it at any time. Given that Lois is 53, that's not likely to be a big problem, but it could have been 10 years ago. Secondly, when she comes to take money out of her pension, she may have to pay tax. So to try and compare apples with apples, we're going to need to make some assumptions on how much tax she might pay in the future. When you draw money from a defined contribution pension, there are two distinct parts to it. A tax-free part, which is usually 25%, and a taxable part where you pay marginal rates of tax on the income that you draw. However, there is now a lump sum allowance that caps the total tax-free cash that an individual can draw over their lifetime to £268,275, which is 25% of the old lifetime allowance. Because of the size of Lois's pension, the tax-free part would be capped by this limit, whilst the rest of it will be taxable. But how much tax is she likely to pay? If Lois drew £50,270 from the taxable part of her pension each year, assuming that she has no other income, the first £12,570 of this would be tax-free, as it would fall within her personal income tax allowance, whilst the rest would fall within her basic rate band on which she'd pay 20% tax. So overall, that's a tax rate of 15%. By the way, I'm not suggesting that drawing £50,000 per year from her pension would be sustainable. All I'm trying to do is assess the potential tax she might pay. Now, when she turns 67 and gets her state pension, all of her pension withdrawals are likely to be taxable. So to be conservative, let's assume that she pays an average rate of 20% tax on the whole taxable part of her pension. So between this and the tax-free part of her pension, that would leave her with £959,000. That's £190,000 more than in the first scenario. Despite this, there may be personal reasons why this might not have been the best strategy for Lois to follow, but I wanted to use this as an example to demonstrate just how tax efficient pensions can be. In the UK, pensions are the most tax efficient tool we have for building wealth, and the big mistake that everybody makes is not using them enough. So have a think. Are you underutilizing your pension? Maybe you no longer need the flexibility of your ISA, or do you have money tied up in a buy-to-let property that's no longer performing? Now, if you think that trying to be tax efficient before you retire is difficult, just wait until you see what happens when you're retired and you need to create a tax efficient income. To demonstrate this, let's expand on Lois's example and assume that over the following years, she changes tack and prioritizes building up her pension, and even using her ISA to make larger pension contributions, and then decides to retire at 55, at which point she has £300,000 in ISAs and £700,000 in pensions. To make this a little bit more interesting, let's also say she just received £100,000, perhaps from an inheritance or from downsizing, that she's put into a normal taxable investment account. Let's assume she's still predominantly a dividend investor and her portfolio is yielding 4% per year. Lois would like to be able to spend £45,000 per year in retirement. And to make sure her retirement pot lasts, she wants to create that income in the most tax efficient way possible. So the question is, which bucket or which combination of buckets should she draw money from first? In theory, she has 4 different buckets to choose from. She can draw from her ISA, which would be tax-free, and there's the tax-free portion of her pension. She'll pay marginal rates of income tax when drawing down from the taxable part of her pension, and then with the general investment account, she may have to pay tax depending on the dividends that she receives or any gains that she realizes. I want to direct this question at you. How would you go about drawing a tax-efficient income in this situation? Perhaps you might want to pause this video and have a think about it. Very few people get this right first time because, as you're about to see, there are a lot of traps to fall into. Options that may seem rational at first, but would actually end up costing Lois a lot of tax. At first glance, perhaps you might be thinking that if Lois's portfolio is yielding 4% per year in dividends, across a £1.1 million portfolio, that's £44,000 per year of income. That's almost exactly what she needs. So can't she just draw down 4% from each of these buckets? If she did that, what she draws from the ISA and the tax-free part of her pension would be tax-free, but the £4,000 of dividends she's received in her general investment account won't be. She has a £500 dividend tax allowance, so only £3,500 of this will be taxable. And then there's a taxable part of her pension too. In the order of taxation, pension income is taxed before dividends. So part of this pension income will fall within her personal income tax allowance and will be tax-free. She'll pay 20% tax on the rest and then 8.75% tax on the dividends, or just under £2,000 of tax in total. With this approach, we've just focused on income and we've completely ignored the consequences of tax. So without stating the obvious, this is probably not going to be the most tax-efficient strategy. If you want your retirement fund to last as long as possible, you're going to need to be much more tactical. So what else could she do? If the goal is to pay as little tax as possible, she could draw it all from her ISAs or take tax-free cash from her pension. But generally, it makes sense to preserve these tax-free growth environments if you have a taxable account like her GIA to draw from first. But if she did this, she'd be missing an opportunity. As you know, the game with pensions is to get as much tax relief as you can when you're putting money into it, but also to pay as little tax as you can when you're taking your money out, which means that if Lois has the opportunity to take money out of the taxable part of her pension without paying tax, that's something she probably doesn't want to miss. Lois has £3,500 of taxable dividends, which means that she could draw £9,070 from the taxable part of her pension without paying tax. Because Lois does not already have any of her pension in drawdown, to draw this income, she's also going to need to take 25% from the tax-free part of her pension, meaning that she now needs to find an extra £29,000 to get to her £45,000 target. Again, to preserve the other tax-free buckets, it would make sense for her to draw this from her general investment account, although she does need to be mindful of any capital gains she realizes and make sure she draws enough to cover any tax. So what do you think? Is this the final answer? Not quite. We've fallen into another trap here. You see, the goal is to pay as little tax as possible throughout retirement, not just in the first year. So when making decisions about where to draw income from today, we need to think about the knock-on effects this is going to have in the future. At some point in the future, it's highly likely that Lois is going to pay at least basic rate tax when drawing money from the taxable part of her pension, which is 20% tax. Whereas the basic rate tax on dividends is only 8.75%, meaning that if we're confident that this is going to happen in the future, it would actually be more efficient to draw £12,570 from the taxable part of her pension today. This would push her dividends into the basic rate tax band, but in effect, she's able to take an extra £3,500 out of her pension for only 8.75% tax, which is far more preferable than paying 20% tax in the future. You see, sometimes we don't mind paying tax today if it means that we're going to pay less tax in the future. So this is the solution for year one. But what if we fast forward 2 to 3 years? By this point, she would probably have depleted her GIA, not only because she's used it to fund her income, but also because she should have been using it to fund her ISA allowances each year. So how should we go about funding her expenditure now? We could do a similar thing as before and draw down the maximum amount from the pension without paying tax. And then to avoid paying any tax, we could fund the rest from a tax-free bucket. But which should we choose? Do we take tax-free cash from the pension, or do we fund this from her ISA? An ISA and the tax-free part of your pension are similar in many ways. Money inside them is invested and grows free of income and capital gains tax. And then when you come to take money out of them, there's also no tax to pay. But there is one important difference. Pensions fall outside of your estate for inheritance tax purposes, and if Lois died at 57, her beneficiaries would inherit her entire pension as a tax-free lump sum, which is a huge benefit, whereas an ISA would fall inside of Lois's estate and inheritance tax may be due. This is the reason why it often makes sense for retirees to first draw down on assets that fall inside of their estate before touching their pensions. If inheritance tax is not a concern, then it's not so much of an issue. But let's say that Lois is concerned about this, so decides to draw down on her ISAs to fund the remainder of her expenditure. But again, is this just another trap? We've purposefully decided to draw on her tax-free buckets to avoid paying 20% income by drawing more from the taxable part of her pension. But by avoiding tax today, again, does this just mean that she's going to pay more tax in the future? To try and answer this question, we're going to need to make some projections. If Lois keeps drawing from her ISA like this, at some point she's going to deplete it. By that point, it's likely that she will be in receipt of her state pension, which is going to use up most of her personal income tax allowance, meaning that she's going to have to pay tax on anything that she draws from the taxable part of her pension. If she pays 20% tax, that's not much of a problem. But if it's 40%, perhaps she would have been better off drawing more from her pension earlier in retirement and paying 20% tax. But that would enable her to preserve her ISA so that she could use it to keep her out of these higher rate tax bands in the future. Fortunately for Lois, she still has the tax-free part of her pension remaining that she can use to do the same thing. So this should not be a problem. I say should because in the future, as a result of inflation, Lois is probably going to need to spend a lot more than £45,000 to sustain her quality of life. To fund this, she's going to need to draw more from her pension. And given that tax bands have a habit of not increasing in line with inflation, it's more likely that this is going to fall into higher tax bands. We also don't know how pension rules and other legislation might change. So it's important to recognize that when trying to work out what's the best way to draw the most tax efficient income, sometimes there is not going to be a definitive best course of action. And all we can do is focus on what we do know, make the best possible assumptions about the future, and where possible, hedge our bets. I suspect that this video might have raised more questions than it's answered, but hopefully I've been able to illuminate some of the many pitfalls people fall into when trying to create an income in retirement. And I'll be creating a lot more content on this topic in the future with different examples. So please do subscribe if you haven't done so already. I'll see you soon.